Hello and welcome to London Property. I'm your host Mahnaz Fazaipour, and today we're doing our market updates, and we are delighted to welcome back to the show Kris Eriksson. Welcome back.
Thank you very much. Delighted to be here.
Kris, I'm going to hand it over to you for the introduction, and I know that we've spoken to you before in the context of what goes on the river, but you can tell us, a bit more from your area of speciality, what's been going on in the market.
Yeah, absolutely. So my area or our area of speciality is now more based around prime central London. So similar to the people that you're interviewing as well here. The prime central London market, it's gone through a bit of turmoil. Depending on who you speak to, there are two different categories. Some are saying that they are seeing some of the best and biggest transactions that they've seen post-pandemic, and others are saying there's not much action happening in the property market. I think that the 10 million plus market has done relatively well over the last 6 months. With uncertainty comes opportunity. And whenever there's uncertainty, you see people trying to be optimistic and trying to take a punt. And those at the very highest levels, say 15, 20 million pound homes, can afford to transact at 2, 3, maybe even 5 million pounds off their asking price, which to a willing buyer represents good value, and the seller gets out. Having sat on the property for numerous years, has probably seen that capital appreciation. Where it gets tricky is your 1 million to 5 million pound market, because most of that value has appreciated over time. And for those looking to sell, they are having to buy something of equivalent value. However, prices have come down and the market hasn't had time to react to it. And that creates a stalemate situation where sellers want to sell, but they need to achieve a certain price, and buyers want to buy, but affordability is an issue. So we've ended up in a catch-22 scenario where we have buyers willing to buy, sellers willing to sell, but there's no equilibrium price.
So basically what you're saying is that the sellers haven't really become realistic about what's going on in actual market conditions, but the buyers are actually very much aware because they've been out looking.
Yeah, correct.
And that hasn't happened. The other thing that I've noticed is anybody who's bought sort of 2014, 2015, selling now means losing.
Correct, yeah.
So you really have to go before that,
yeah,
to get to the people who are like, okay, fine, I'll sell.
100% right, and very accurate statistics as well, because Matt and I recently did a pricing strategy where we looked at, you mentioned the river before, we have a lot of expertise there. The reason why I come back to the river is because a lot of the new developments that were built on the river started 2012, 13, 14 and onwards. So a lot of the developments that you see now, around Battersea Power Station and Nine Elms, their first phases started completing in 2014. So it's very easy to see or to track back where the prices are. And the reality is that you probably have to go back to 2012 now in terms of where we sit at the market. And that's a tough pill to swallow for a lot of owners. I think they are realistic. They're just not in a position to be able to transact because they'd effectively be selling in negative equity.
And going back to 2012, 2013 was when all the taxes started changing.
Correct. Against
people owning in non-natural names, being overseas, leaving properties empty. So, everything started to... Unravel. And we're now seeing the results of all that unraveling. So going back to Nine Elms, actually, interestingly, I was there the other day looking at the Bloom development, which is probably the most centrally located build-to-rent that there is.
Yep.
Are you finding that the people who bought in these new developments over there, potentially as rental investors to begin with, are holding out, or are you finding that they're exiting?
It's a very mixed bag. I guess it depends on their own investment strategies. I would say that the majority are holding on to it because the rental yields remain good. Rental prices, when I checked this yesterday, they say that in London, rental prices are on average 32.5% above pre-pandemic levels. Now that was one heck of a ride. During the pandemic, prices flatlined. We had a lot of tenants who were moving out of their current arrangements to move back into the neighbour flat because there was such a discount in between what they were paying and what they could achieve. But since then, prices have come up. And it's, as I said, I think it's on non-res, that statistic, 32.5% above. So if you own a property for rental purposes strictly, then the yields are good. The problem is that service charges have increased, the cost of living have increased, utilities have increased, and that of course impacts the final yield. So that's where owners, traditional landlords who own 10, 15, 20 properties, period properties or mansion blocks, have been looking at relinquishing some of those assets because they're no longer profit generating. On top of that, capital gains, inheritance tax and everything else, you take all that into account and it doesn't seem like such a good investment. But those build to rents were built on a completely different model where all this was factored in over a 10-year period. So you're pretty much guaranteed that yield for the foreseeable future. So.
And what are you seeing as a kind of any kind of light at the end of the tunnel, or are you seeing any kind of trend, people coming from certain countries, or what people are doing with the stock that they have?
Yeah, so in terms of the trend, 25% of buyers in the London market are international buyers. And so where are those overseas buyers? Well, it's a mixed bag, but 40% of that 25% represents Indian buyers. So they're the number one international buyer in the UK. Makes perfect sense since they've gone through massive growth over the last 2 decades. There's a lot of capital, a lot of wealth, and there's a natural tie to London. Let's not forget that London remains, no matter how difficult and how challenging it is out there, London has some of the best universities, the best schools. We may not agree with the political system, but it's safe. We know the outcome. From a defense perspective, it's safe as well, and the time zone. Everyone has to travel through London to get anywhere else in the world. So it represents a very unique investment, and also not just an investment such as buying a property in Dubai, but also an investment for the future, for generations to live, raise children, and so forth. There's a lot of talk about American buyers. I'm on the fence.
Yeah.
There's always talk about American buyers as soon as the pound strengthens or weakens. I haven't seen an influx of American buyers. I can see that for some it might represent good value, but I can't sit here and honestly say that we're inundated with American buyers. There's always American buyers. It's a huge continent and it's a lot of wealth.
Yeah.
So.
I mean, I have to say, when I'm walking my dog, I do hear American voices almost every single night, but then, it could also just be tourists.
Could be.
So if you had to predict what we've got lying ahead for us, what would you say that is?
Wow, a very similar question to what you posed to me last time we were here. I looked at this video a couple of days ago in anticipation for this interview, and I think we suggested that prices would come down a bit to take into account of the macroeconomic effects that were taking place. Then the reality is that they didn't. They didn't come down. And that's not necessarily unexpected, because London is a unique place to own and buy real estate assets. A lot of that is done on very low loan to values, so very cash rich. So when the market takes a turn, people don't necessarily have to sell because of mortgage or interest rate hikes. They have very, very small amounts invested in that. Now we have a completely different world. The macroeconomic outlook is uncertain at best. We've got conflict in the Middle East. We have conflict in Russia, Ukraine. Europe has its own economic challenges. America is about to have Donald Trump back in the White House for the second time. There's a lot of uncertainty. What worries me somewhat is that we have ended up in a demand pull inflation, meaning that higher costs of living, higher cost of utilities and resources is causing wages to increase, causing inflation to rise. The only tool that the government really has to affect that is to up interest rates. And that normally subdues wages. However, in this case, it hasn't. So you have interest rates going up, wages going up, and inflation going up all at the same time. And it's the sort of Pandora's box from an economist's perspective. That's a bit of a concern, because you could end up in a situation where we see no economic growth and we see higher interest rates. And that leads to something called stagflation. And that we saw last time in the 1970s during the first and second oil crisis. I'm hoping that that doesn't happen, because if that happens, well, I guess property price will have to come down, in which case they might become more tradable. So it might end up flipping on its side. The reality is that most of the research out there suggests that prices will increase by about 4%. That was the latest report from Savills.
Right.
So that was 2025 predictions.
Yeah, I think we're starting to think that predictions are probably to be ignored in these climates that we're in.
Yeah.
And, having had a flat market for the best part of 10 years, then I guess flat is another way of saying going down.
Correct.
So potentially with all this talk, probably by design, to push away the overseas demand and try and bring the market back to the locals.
Yeah.
So are you seeing any increased activity for people, trying to get onto the property ladder, but actually locals considering some of the things that you'd never dream of locals actually buying? Yes,
to some degree, particularly in the new build market, because that was very much designed. It was designed, built and sold to overseas buyers. It was Malaysians, Singaporeans and then Chinese. And the UK market was never taken into account when they built these, on size, on the various facilities. However, since the UK government has made it less attractive for international buyers, particularly with upcoming stamp duty increases, among many other things, you're starting to see that British buyers are coming into that market. But they are far and few between, because this comes down to affordability. And a lot of international buyers had a lot of capital at their disposal and were able to put down a few £1,000,000 as if it was nothing in reality. A domestic buyer isn't in the same position, so is unable to do those sort of transactions. And that means you end up with more stock on the market, which would normally mean that if there's more supply, less demand, prices should come down. They haven't yet, so let's sort of see where this leads. But from our perspective, we're hoping that prices will come down, because that will regenerate the market.
Yeah,
because
you might also find that these people who can't sell at the prices that they want can take advantage of the rental market, go back on the rental market and wait. So, we've been in this kind of, it seems like we've been on Groundhog Day for 10 years.
It does.
Well, thank you very much for coming, and we look forward to having you back on the show again.
Thank you. Thank you.
If you are looking for solutions in the prime central London real estate market, every person that we interview specializes in something different, and we'd love to hear from you, and we'll be able to connect you to the right person for your challenges and opportunities that you might be looking for.